Welcome to This Week in Money. I'm Phil Mackesy. Today, Marin Katusa talks natural gas. Gerald Celente on the next war. And David Smith covers gold and silver. We begin with Marin Katusa right after this.
It's all about money. At the HowStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on junior markets and more. Plus, visit with industry exhibitors. The HowStreet.com Money Expo in Victoria at the Conference Center, Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca. It's all about money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Marin Katusa is Chief Energy Investment Strategist at Casey Research, and he's Senior Editor of the Casey Energy Report. He's online at caseyresearch.com. Hey, Marin, it's good to talk to you again.
Always a pleasure, Phil.
Natural gas making headlines again. Marin, the lowest prices in a decade. U.S. inventories at record high levels, the most for any week of April in almost 20 years. Give us a thumbnail on what's going on with nat gas.
Well, in North America, remember, natural gas is a very localized market. North America natural gas sector is a victim of its own success, mainly because the producers have been so successful with the unconventional technology. We've been writing about this for many years, and unfortunately, it's not going to change anytime soon for the natural gas investor, but hence, that is where the opportunity lays. So, what's interesting is, yes, where there are, much higher, they're 55% higher inventories than they were a year ago, but it's also lower demand. It was a much cooler winter than expected, and people are expecting, well, maybe it'll be a hot summer, and the air conditioning units will be peak loading the power, but historically, much more electricity is generated in the winter than there is in the summer. So not only that, with the valuation with these shales, the companies drill for the NGLs, the natural gas liquids, and the gas is irrelevant at this point.
Okay.
So we could even see an area of $1.25 per MCF gas in North America. We saw as low as about $1.40 in Alberta on the AECO spot price. So it's getting ugly, and it's going to continue to stay ugly for the next 12 months.
Marin, for folks thinking of getting in on the natural gas bandwagon, just in the nick of time, you and the Casey folks have put together a great piece. 5 tips for natural gas investors.
Definitely. I highly recommend all of your viewers and listeners to go to our Casey Daily Dispatch. It's a free blog on our website, caseyresearch.com, and BNN, which I'm regularly on, asked me to talk about what 5 tips I would have for the natural gas investor. And you can watch the video there on that's Tuesday's Daily Dispatch. But really the 5 main things, Phil, is number 1, there's going to be a coming reserve write-down. You see, when the engineers do a reserve evaluation, they have to base it on how much gas is in there. So the amount of gas you have in your deposit is called a resource. But if you have a price, let's say at $3, that means how much gas do you have that's economic at $3? Well, last year it was done at $4.50. This year in January and February, when a lot of these engineers were doing these evaluation reports, they were using $3.40 natural gas. I was the first guy to come out in the media and say, whoa, let's stop. We need to pause here. This doesn't make sense. The AECO spot price is somewhere around $1.50, and you're using a $3.40 to evaluate what's economic reserves. That doesn't make any sense to me. So basically, logically, if you use $1.50, you're going to have much less gas. And now the companies are starting to write down their reserves, basically saying we have about 40% less than we originally had because the price is a lot lower. So that's the one thing. Make sure you understand that if you're investing in a company like Encana or whoever, as a Western Sedimentary Basin gas company, you understand what their reserves and the potential write-downs. So be careful for that. The second one that I highly warn people to invest in is BOEs. It's a term that was picked up in the 80s, and the SEC allowed it, based on barrels of oil equivalent, based on the ratio of 6 to 1 on oil to gas, because it's on energy equivalent. Therefore, for many, many, many years, oil and gas traded economically. Oil traded 6 times the price of an MCF. So, unfortunately, the price right now is about 65 to 1, 70 to 1, depending where you are in North America. And the energy equivalent is 6 to 1. So there's a big arb. So a lot of promoters or companies are presenting their information in barrels of oil equivalent. You need to ask yourself, is this dry gas? Is it wet gas? Is it oil? Because not all BOEs are equivalent, even though they call it barrels of oil equivalent. So that's another thing to be careful of. The third one is IP rates. A lot of people get excited about initial production. But what investors have to understand, with these unconventional deposits, the production has massive decline rates. Okay? So just because a company comes out with 1,500 barrels of oil equivalent per day initial IP rate, you got to read that whole press release, and about on the third page they say this was a 22-hour IP test. Well, the standard is about a 90-day. You can go to a 30-day, but within 100 days, that initial IP is going to decline by about 90%. So that was 1,500 barrels of oil equivalent the first day, will roughly have about 150 barrels 100 days later. So that's the third one to be careful. And for the last two, which are very important, go to the website and have a look. The education is more than worth it in just a few minutes of your time.
Now, what about doing some due diligence on the company itself and checking out what it's worth, doing the financials?
Well, exactly. If you're going to be investing your hard-earned money, all of this information, especially the financials, and you can find them on the company's website, or you can go to cdar.com, which is a free website. This information's there, and especially in production companies, you have to go through the financials. Our office, we've got many CFAs, we've got geologists. We go through this information, and you have to understand there's a valuation from the financials perspective and also the geological perspective. And that's why Doug Casey's 8 Ps are so important, because it goes from the P all the way to the geology, all the way down to the physical structure. So it's very important to understand the different aspects of what makes a company successful.
Marin, with the markets going up and down, it's sideways these days. A lot of folks running towards dividends, and that's no different in the natural resource sector. As a matter of fact, you ran against an interesting dividend story when you were in Calgary.
Be careful about chasing yield.
Yeah.
A lot of people are going to be overpaying to get paid, and it's really a self-fulfilling prophecy. And be very, very careful, because if the spot price of oil drops a little bit, will that company be able to sustain the same type of yield? So you have to ask yourself, what's the payout ratio? What's the debt coverage ratio? All these types of questions to give yourself a margin of comfort, and be careful about overpaying to get yield.
We're talking to Marin Katusa from KCResearch.com. And don't forget 5 tips for natural gas investors. It's the latest if you are interested in natural gas. Let's look at some company news. Baker Hughes, the world's 3rd largest oil field services provider, reporting Q1 results. They beat the estimate, but earnings are down 30% from last year. And they say, among other things, the shift from natural gas to oil-directed drilling rig activity, supply chain issues, and something they're saying here, maybe you can help me on this, an oversupply, Marin, of pressure pumping across the market. What does that mean?
So basically what's going on, as we're getting into the more required multi-fracs and the longer horizontals, the natural gas, the Canadian equivalent was gas frac, where they situate themselves with a little bit more expensive technique to extract the unconventional gas in the shale potential. Unfortunately, it's just not economic now, so companies are pulling back from gas production and going towards more liquid-rich plays or oil. And unfortunately, the market is shying away. If you look at Halliburton and Schlumberger, which are bigger than Baker Hughes, Halliburton's trading at about 8 to 9 times earnings, so it looks cheap. Unfortunately, could it get cheaper? Maybe. We like that company quite a bit. Baker Hughes is a great company. The Canadian equivalent is Trican. So with the pumping capacity, you got to see. Remember, you're going about 2,000 to 3,000 meters vertically, and then another 2,000 to 3,000 meters horizontally. So you're going to have multi-fracs, you got to have high horsepower and major pumping capacity to pump that water after you frac it out, and also the liquids.
We're talking to Marin Katusa on This Week in Money. Other oil news: Royal Dutch Shell increasing its offer for Cove Energy. That's a nat gas explorer to $1.8 billion. They want to get into the nat gas industry in a big way in East Africa. Cove Energy in Mozambique, and that's obviously an area of interest for Shell, Marin.
Well, without a doubt, you look at what's going on in the East African, the rift with Tullow and Africa Oil. This is a company that we've been talking about for 4 years, and people have made up to 3, 4, 500%, depending on when you sold. These are some of the largest onshore discoveries in the last decade globally. The area has the potential within Uganda and Kenya to be larger than all of the North Sea combined. And this is virgin territory. The infrastructure is still lacking, but remember, a company like Shell is looking for the long-term strategy and exposure to the upside. So the infrastructure still needs to be built in the area, and that will not be cheap, but it's about securing resources for the future because, look at China and Russia and India. There's a resource war going on. Look what's going on in Sudan. So all of these things are very critical for exposure to large world-class deposits.
We're talking to Marin Katusa on This Week in Money. And news from South America: Spain and Argentina, they are butting heads over the nationalization of YPF. That's a Spanish-controlled oil producer. Last week, Argentina expropriating half of YPF. It's Argentina's biggest oil company. Repsol, this is a Spanish company that owns a big chunk of YPF. They want $10 billion, and they say they're going to sue anybody who tries to develop their oil reserves. What's going on here, Marin?
Well, basically, Cristina and her socialist government in Argentina has decided that it's time to nationalize things. They took over the pension plan. They're now getting into the oil and gas sector, and they're going after the biggest player, YPF, which is everywhere in Argentina. Now, on our website, we've been saying we actually wrote the first Argentina report on the shale potential in April of 2010. We've always loved the area geologically. The potential of Argentina, both in the mining and oil and gas sector, is some of the best rocks in the world. Unfortunately, the people there are probably the worst when it comes to foreign investment. And with the coming nationalization, will it stick to just oil and gas? We don't know, but it does not look good for YPF or any of the other explorers, especially in shale gas, because the upfront costs are so high, the fiscal terms do not warrant the huge risks that the investor takes up front. So in our newsletters, we've been saying for a long time, stay away from Argentina from an oil and gas perspective.
Marin Katusa from kcresearch.com, our guest on This Week in Money. And we just got a list here, Marin, from the British insurance firm Stavely Head. They've released the latest list of the world's gas pump prices. And here are the 10 cheapest countries on earth to fill a gas tank. Let's do a comparison here. With $1.40 a liter in Canada, $4 a gallon in the U.S. The number 10 country, the 10th cheapest country, Algeria. Have you been there?
Yes.
Okay, and they're coming in at $1.20 a gallon or 32 cents a liter. Nice, huh?
Well, you'll see the bottom 10 are going to mostly all be OPEC countries.
You betcha. But here's the interesting thing. The cheapest country on earth, it is an OPEC country also, Venezuela, 18 cents a gallon, 5 cents a liter. Sounds terrific on the surface of it, doesn't it?
Well, it does, but you look at the subsidies that Chavez is paying to keep peace in the country. How long is that sustainable? You look at countries like Kuwait, Saudi Arabia, all these where it's subsidized fuel. Interesting to see where Iran would be on that list.
Yeah, and that, for some reason they don't show up on the list. Perhaps they couldn't get access to the information, I would think.
Well, it's interesting. That's an interesting thought.
While we have a second, Marin, tell me about the 2012 energy forecast.
What we've done is we really played out all of our networks, our connections from the trading firms, We played out what we thought would happen with natural gas, and we stated for the next 12 months, expect lower natural gas prices. We expect a high differential moving forward between the heavy oil, the oil that Canada produces in the oil sands versus, the light sweet crude that comes into the Gulf. So we expect that differentials to stay between 25 to 35%, which is not good for the Canadian oil sand producers, but we see that staying for the next 12 months. We expect the Brent premium to stay just because of the political instability in the Middle East. Coal in North America is going to have suppressed pricings because Australia is back online. And for the rest, go to the website. It's all there.
Marin Katusa is Chief Energy Investment Strategist at Casey Research. He is online at caseyresearch.com. And don't forget to catch Marin at the World Resource Investment Conference. That's in Vancouver, June 3rd and 4th. You can register at cambridgehouse.com. Hey, Marin, thanks for your time. I appreciate it, bud.
Always a pleasure, man. Take care.
Coming up, Gerald Celente on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Gerald Celente is publisher of the Trends Journal and founder-director of the Trends Research Institute. He's online at trendsresearch.com. He joins us today from Kingston, New York. Gerald, welcome back to This Week in Money.
Oh, thanks for having me back, Phil.
Hey, the Spring Trends Journal is out to focus on three key areas: war, freedom, and economics, all tied together neatly in a little package. But I want to talk about probably the most dominant theme here, and that is war, the war against Iran. But we can't call it war, can we? We have to sanitize it.
Oh, yeah, we could call it like they did with Libya. What do they call it? A time-limited, scope-limited kinetic action. A humanitarian mission. Yeah, that's it. This is nothing more than propaganda, or maybe impropaganda, if there was such a thing. And what's going on, and is very, very important for, we believe, most people to consider looking at. And that is, history is repeating itself. And the only thing we learn from history is nothing. And here's how history is repeating itself. The crash of 1929, followed by, of course, the Great Depression, currency wars, trade wars, World War II. The Panic of '08, the Great Depression/recession. There's a depression in Spain, a depression in Greece, a depression in Italy, a depression in UK, a depression in Portugal, a depression in Ireland, a depression in Romania, Lithuania, Hungary. There are depressions all over the world, all over the industrialized world. Now, currency wars, right? They're already going on. Brazil's screaming all the time. Australia, New Zealand. Well, look what happened to the Swiss. They pegged their Swiss franc to the euro because of the currency war. And now trade wars. They're heating up. You keep hearing this rhetoric about China, on and on. The next thing is world war, and the world war is unfolding in front of everyone's eyes. Last week, 100,000 people in the Czech Republic. That's a lot of people demonstrating. Demonstrations going on virtually every day in Greece, Spain, Portugal, general strikes in Italy. They're going to be voting on a referendum whether or not to keep going with the euro bailouts over in Ireland. When the money stops flowing down to the man on the street, the blood starts flowing in the streets. It's war. It's only different. And now what they do, as they always do, what they do is they identify an enemy for everyone to hate. And remember, let's go back to after 9/11. Besides Osama bin Laden, it was them Taliban, I tell you. And what we're going to do is we're going to get Al-Qaeda, and they're never going to be able to go anywhere again. And 11 years later, and $1 trillion lost, America's still there, as are their flunky allies. Canadians included. I mean, all the money that they keep sending over there and the troops. So you look and it's just another level of history. And now, of course, last week we saw every day in the news, the North Koreans are going to launch a rocket in a dangerous area of the world. And you look at this footage, and it looks like these guys had a big erector set. One lousy stinking rocket that barely made it off the launch pad. They had the people freaked out in fear and hysteria for over a week. Oh, by the way, Phil, last week, wasn't it India that just sent up an ICBM that could hit Beijing and Shanghai?
Yeah, but that's okay.
That's okay. You know why? Because they're doing business on our terms.
Yes.
And the same thing with Pakistan. The same thing with Israel. How many nuclear bombs? No, don't talk about Israel's nuclear weapons. We're not allowed to. No, it's off the... No, you're an anti-Semite. Can't talk about their nuclear weapons. And you can't talk about France's nuclear weapons. You can't talk about the U.S. nuclear weapons, Russia's. But in Iran, if Iran has a nuclear weapon, then they're going to wipe out Israel. That's the propaganda. And it keeps going on. What have they got? One weapon they may have in a couple of years. Israel has 300 of them, ostensibly. You know, if Iran attacks anybody, they turn the country into glass after they'd be bombed so hard. But it's the propaganda and the fear and hysteria to keep people's minds off what's going on economically. The housing market continues to decline. There's a depression in Spain with over 25% of the people unemployed, 50% youth unemployment, and that goes through with a lot of other countries around the world. So when all things fail, they take you to war.
We are talking to Gerald Celente on This Week in Money, and I love this quote here from Trends Journal. You mentioned that Iran is a replay of World War II, but in reverse, and that's fascinating. Explain what you mean by that.
Well, what happened is that, again, people forget the fairy tale. They believe the fairy tales. History is written by the victor. And as I mentioned earlier in this conversation, it's a replay of World War II, trade wars and currency wars. Japan was the China of manufacturing and dumping cheap product onto the markets back in World War II days, pre-World War II. And so what the United States, Netherlands, and the UK did was they started shutting off Japan from getting any natural resources, including oil. Now they're playing a reverse flip with Iran. What they're doing is they're calling a state of war, an embargo. Everybody look up what embargo means. An embargo means war. They can't sell their product, oil. And some 60 to 80% of Iranian income comes from the sale of oil. And now because of the United States, the European Union, and other countries and areas of the world, they're shutting out Iran from selling oil. So they're putting them in a warlike position as they did with Japan. Does it make it right when they strike back? No. But does it make it right to put sanctions on them to force them into action? No.
Are you getting the feeling, Gerald, that this whole Iran situation is simply Iraq in a different package? They've just changed the name, and the same kind of conditions are going on, right?
Yeah, what they do, and remember the Iraq War. How come nobody's brought these chicken hawks like Tony Blair and George W. Bush and Cheney and Rumsfeld and all the rest of them that told us that Saddam Hussein had weapons of mass destruction and ties to Al-Qaeda, and none of the free world was safe unless we overthrew his government. And they never found any weapons of mass destruction and ties to Al-Qaeda. And yet the war went on for how many years? 8 years? $1 trillion spent? 1 million Iraqis killed? And the hypocrisy. No one ever says anything about this. They used to call these war crimes in the old days. Now it's just, let's forget about it ever happened and let's start a new one.
Interesting messages coming out of Washington these days, Gerald. And if you think the president is hawkish on Iran, what about Romney, Santorum, and Gingrich? Here's Gingrich. I couldn't believe this. Worried about a missile strike on Cleveland.
Yeah, I know. And Santorum, one on Greenville, South Carolina. Yeah, madman mullahs,
Yeah.
But again, they use fear and hysteria. And Romney, I mean, this guy, he's shooting his mouth off about what we have to do with Iran, and his vice presidential candidate, ostensibly Mark Rubio, what they have to do to Iran and unilateral action.
Mm-hmm.
Here's, Romney is around my age, 65.
Okay.
And I was, of course, prime draft meat during the Vietnam War. And the way Romney beat it was that, now remember, 1965, 67, 68, imagine what France was like. Wine-loving, cigarette-smoking, caffeine-addicted, Brigitte Bardot-loving France. And there they send them over as a Mormon missionary to convert, all Catholic France, to convert French people to Mormonism. That's how that little slime ball with his big fat mouth beat the draft.
Wow.
Now wants to take our country to war. All these men with cojones the size of mothballs, they're ready now to tell us what we should do and how we should fight, as they never even have been in a schoolyard fight, let alone a barroom brawl. These little chicken hawks who would never send their children and don't have the courage to send themselves, now they want to start a new war. Here's what I have to say. Anybody that wants to go to war, go.
Yeah.
Send your wife, send your kids, send your money, lead the charge, keep me out of your psycho trip. And don't give me the line that I don't support my country.
Yeah.
I support the Constitution. My country's not a bunch of flunky, little, lame politicians. That's not my country. These people couldn't lead me across the street. And yet people go. And what they do is they prey on the weak, they prey on the patriotic, and they prey on the people that have no other alternatives in life, so they join the service to earn some money and possibly go to school. And then they sacrifice their lives.
Gerald, the only guy who seems to make any sense on Iran is Ron Paul. He wants U.S. foreign policy to follow the golden rule, and they boo him for it.
And that tells you the state of the American nation. Go listen to Obama's State of the Union address back in January. He began it with war and ended it with war. And that's what this nation is. It's a nation that Dwight D. Eisenhower, 5-star general, Supreme Commander of the Allied Forces, 2-term president, a Republican at that, he leaves office and warns the American people that the military-industrial complex is raiding and ruining the country and robbing it of the genius of its scientists, the sweat of its laborers, and the future of its children.
We're talking to Gerald Celente on This Week in Money, and let's look at the big war picture for a second here. You're asking here, I think, a great question. How is it possible that in a democracy, debate is stifled while war's being waged? Why are we so afraid to look in the mirror of history?
I was just in Berlin, and I saw what was. You could see the destruction that happened from World War II with the new buildings built in between the beautiful old ones. And I kept saying to myself, how did this keep going on so long? How come the people didn't rise up and stop them? And I have German friends, and they all tell me the same story. They said, when I was 16 years old, when one 48-year-old woman told me, I confronted my grandmother and said to her, how could you have let this happen? How could you have let them take the Jews away? How could you have let them take us to war like this and destroy our country? And the grandmother said to her, you don't understand. We didn't lose our rights in one day. They were taken away from us week by week, month by month, year by year, until we had none left. And then when you spoke out, they would take you away. You'd never hear from you again. And you couldn't talk to your neighbors. You couldn't even talk to relatives. You were afraid. And that's what's going on now. And that's why the cover of the Trends Journal is all aboard. Next train to Auschwitz. Kiss those calories goodbye.
Yeah, exactly.
And this isn't done to, to inflame people with rhetoric.
Mm-hmm.
It's done to make people look at what's happened, for example, in the United States, with the passage of the National Defense Authorization Act on New Year's Eve, when no one's paying attention. That allows the president now to call Gerald Celente a belligerent of the state, have the military come and take me away, have no judge, no jury, no trial, no charges, no habeas corpus, and they could kill me. Just like that. Boom. Jack, you're dead. They don't know about the Supreme Court ruled about 3 weeks ago that if you don't have your seatbelt on, you have a little argument with a cop and they arrest you and they take you to jail, bend over and spread your legs.
Yeah.
The Supreme Court said strip searching could now be done on everybody and anybody that's booked to go into jail. This is America. Try this one. El Presidente of Los Estados Unidos, the banana republic just south of you, he could now declare martial law under executive order at, quote, a potential threat.
Wow.
Yeah.
Huh.
Oh, here's one more. Big Brother, now every stroke of your keyboard, every conversation, listening in right now, whether it's on the telephone or cell phone or whatever you're talking, whatever images they pick up, what they're doing is they're putting algorithms in place to determine whether or not you are a future terrorist or could become an enemy of the state.
A potential threat.
That's right.
Yeah. I feel like a potential threat just talking about it.
Yeah.
Gerald Celente is publisher of the Trends Journal and founder-director of the Trends Research Institute. Spring Trends Journal is out. You don't want to miss it. Much more on Iran, plus the battle for freedom, and some great stuff on the state of the world economy. Put your money where your mind is and subscribe. You can find out more at trendsresearch.com. Also, if you're on Twitter, Gerald Celente, and YouTube, Gerald Celente Channel. Always interesting, Gerald. Thanks for talking to us, my friend.
Hey, thank you, Phil.
After the break, David Smith on This Week in Money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
It's all about money. At the HowStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on junior markets and more. Plus, visit with industry exhibitors. The HowStreet.com Money Expo in Victoria at the Conference Center, Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca. It's all about money.
This Week in Money is archived online at talkdigitalnetwork.com.
David Smith is a precious metals analyst, and he's a frequent contributor to the Morgan Report at silver-investor.com. He joins us from Tempe, Arizona. David, good to have you back on This Week in Money.
That's great to be back, Phil.
It is good to hear from you, and we're going to focus today on gold and silver, your specialty. We're going to look at what's been happening in the last 12 months and what is coming up next. Hard to believe, David, a year ago, silver was at $48 in the silver-gold ratio at its highest level since the early 1980s. Since then, gold is up 5%, silver down 35%. What's been going on?
Well, that was an amazing time, and we're literally just a few days from an anniversary date of that top, which was, like you said, just under $50. But things kind of got ahead of themselves, and the prices got smacked down, and they've had several rally attempts that haven't worked out. And one of the things that's very interesting, silver had been as low as around $26. It's holding above $30 now, and what's happened? The mining stocks, which have been, there was already quite a disparity between the mining stocks and gold, especially, have continued to widen to the point that it's it's got wider and wider, and people just wonder how big that jaw is going to get before it snaps shut.
Now, give me a sense of how big that gap is right now.
Well, some sources say that the gap between where the price of gold is and the relationship to the gold mining stocks is about as wide as it's been in the last 15 years. And if you look at a mathematical equation, it's about 3 standard deviations from the expectation of the norm. And that would indicate that there's a 99.4% probability that gap will close.
Okay.
And, of course, we don't know whether that closes because gold moves down to move toward the mining stocks, or whether the mining stocks move up toward the gold price, or something in between. And my bias is that the gold stocks are going to close that gap over the coming weeks and months. Not close it, but certainly make it much less of a gap than we've seen over the last 3 to 4 years.
Let's look at the macro picture here, and our friend Ross Clark pointing out it's not the decline in the U.S. dollar, but the drop in all currencies that's making gold go up.
That really seems to be the case because if you look at most currencies priced as the price of gold, you can see that would state exactly what you just mentioned.
Now, central banks also a factor here. We got some news here from the IMF. Central banks buying more gold. Mexico, Russia, and Turkey adding almost $2.5 billion worth of gold in March. That's got to be a factor.
This has continued unabated since 2009, and that was the point at which central bank buying of gold exceeded this hoarding of it, which had taken place for almost 20 years. And stats I read this morning showed that about 10% of the global output of gold, the production, is now being purchased by central banks.
We're talking to David Smith on This Week in Money. Here's another stat just in from the World Gold Council, talking about the volatility of gold. They're reporting the price of gold 25% more volatile during the first quarter than the long-term average. So obviously we've got to be careful of the volatility in the gold price.
Definitely, and I think one of the things, whether we like it or not, is that you're going to see volatility being your constant companion for the rest of this bull market, gold, silver, and mining stocks, and people are going to have to put up with bigger swings, not just what we've seen over an intermediate period of months or in the case of the last year, but even on a daily basis. I think they're going to get shocking as we move out the next year, 2, 3, 4 years.
Dave, here's another nugget from the World Gold Council report, same report, and I shook my head when I saw this. They're saying the long-term correlation of gold to gold equities remains, in their words, statistically insignificant. What's that mean?
Well, I don't know where they came up with that, but if they look at the chart of how the gold stocks usually track gold, generally speaking, the expectation that investors have is that they're about twice the move of gold. So if gold moves up $100, the mining stocks would move up on a percentage basis to reflect that about twice that much, and that's the reason investors have been willing to accept greater risk in the mining stocks than the gold. As you know, if you buy the gold, then you're influenced your profit or loss by whether gold goes up or down.
Mm-hmm.
But if you buy a mining stock or an indices of mining stocks, there are about 30 different factors that could make a difference in whether that stock goes up or down, despite what happens to gold.
We're talking to David Smith on This Week in Money. Let's look at the gold and silver price over the last year. Compare that to the performance of the two big precious metals ETFs, the GLD and the SLV. The GLD first. Here, with assets of $68 billion, a giant ETF, it's up 8%, and the SLV smaller, with assets of $10 billion, pretty much as you'd expect, reflecting what's going on in silver. It is down 35%.
Yeah, there's other things going on with these ETFs. You know, there's short selling going on in the context of the ETF, and they track reasonably closely. But they're not supposed to be necessarily a mirror image, but they're supposed to be reasonably close. And as long as they do that, investors will have confidence in them, and they have certainly continued to add to their the amount of bullion that they supposedly have throughout this bull market. And as long as that continues, that would be a very positive development for the continued uptrend, the secular uptrend in the markets.
What do you see happening with the GLD and the SLV over the intermediate term?
I think backing and filling, some selling, some buying, and perhaps if we see quite a bit of buying going on, that might be a tip-off to the next upward move in gold and silver. That could be just one factor to consider. Okay,
now let's look at the two big mining ETFs, the GDX, the senior gold index, and the GDXG, the junior gold miners. Starting with the GDX, assets of $8 billion. It is down 24%, and not really surprising when you look at the big holdings. The top three, Barrick, Goldcorp, and Newmont, they're all down about 25% over the last year.
Right, and in spite of the fact that some of these in the index actually pay a dividend, which is a consideration, the indices, again, they're not going to exactly reflect the fortunes of any given company, and of
Sure.
course you know that there's a weighting issue there, but with certain stocks making up a larger percentage of the indice than other stocks, and if you had a small weighted stock that did very, very well, it wouldn't necessarily pull that indice up the way that a large one would. So, a person has to realize that they're not mirror images of a given mining company.
Now, is all this being driven by fundamentals, or is a lot of this sentiment? What's going on here?
My feeling, Phil, is that right now sentiment is trumping fundamentals and it's trumping technicals, and it may be influencing technicals. And, of course, the high-frequency trading, which is a fact of life now, not only for the broad stock market but also the mining indices, these things throw kind of a loop into your evaluation as to what you're seeing. Are you really seeing what you think you're seeing? And so it's difficult to make a value judgment based upon one or two factors. I think the more factors that you use that confirm in a certain direction, the more comfortable you can be that your analysis perhaps is correct going forward.
We're talking to David Smith, and boy, you think the seniors are taking a pounding. Look at the junior miners, the GDXJ. This is a slightly smaller ETF, $2 billion in assets. It is down 44% over the last year.
Well, within that indices, there are several of those stocks that had some unpleasant surprises. We had one stock that a major suitor pulled away from it, and we've had several others with unexpected earnings issues. But a lot of those stocks, several of them have recorded, record earnings. There was one in particular that I happen to know of and hold that, that a couple of weeks ago they recorded record earnings and record silver production, and they're down about 25% since then. So that's would support my thesis that sentiment right now is the 800-pound gorilla in the room. And when sentiment changes, for example, and goes positive, then there's a tendency for the technicals to follow that, but sentiment will lead that, I think. And so that's, I think, what people need to watch for is the overall feeling that things are going to change for the mining stocks and that as a whole they're going to move up. And when sentiment is negative, it almost doesn't matter what any given company is doing. They're all going to struggle, and the ones that are having more trouble, of course, are going to struggle even more. So it affects the whole sector.
More with David Smith next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
David Smith here with us today on This Week in Money, and we're talking gold and silver. We mentioned at the top, Dave, gold up 5%, silver down 35% in the last year. And here's an interesting indicator that at the same time period, sales of gold coins and bars in the U.S. down 10%, silver bullion sales off 40%.
Well, if you and I were talking in 1979 about this, I'd be more concerned about it. But here's the thing. The majority of the buying of the metals in the last bull market was a United States, North American, European phenomenon, and that has virtually completely reversed so that now it's India, China, Asia phenomenon, and we're a much smaller percentage of the 100% of consumption in a given year than was the case before. So I would look, and if I saw Chinese and Indian buying falling off a cliff, I would be quite a bit concerned, but I don't see that at this point.
Dave, let's ignore the stock price for a second and look at the health of some of these companies. A lot of these guys are generating great cash flow and great profits. How long before we start seeing more mergers and acquisitions, and how's that going to benefit some of the juniors?
Well, I think that's going to proceed apace in a lot of these companies. As you know, any given company that's a producer is a wasting asset unless they can discover more resource or unless they can buy a company that has it. And so that's going to keep on. I've seen quite a bit going on, M&A going on with companies buying small companies that have a good deposit or very good prospects. And unfortunately for shareholders, they're getting really good prices to pick these things up. One company I know of that was merged just a couple weeks ago, there was around 60 cents a share, and it was a 30% premium over the closing price the day before. But that stock traded last year at over $1.50. So shareholders, they didn't get a super good price for that buyout, but that's just the way it is. And when things go on sale, the majors can swoop in and pick these companies up either through a direct buyout or buying their shares at very attractive prices for them. And unfortunately, the shareholders aren't always rewarded as well as they should be for having taken those risks, and in some cases, holding on for years,
We're talking to David Smith, and I got a two-part question here for you, and we're going to look at what's coming up next for investors in precious metals and then in ETFs and specific stocks. What do you see next in gold and silver, and where does that shine a light for investors in the next couple of months?
Well, there's some real different theories out there. Some people feel that we'll sag and be kind of flatlining for the next few months. Others feel that we're very close to an explosive move to the upside, and nobody really knows. But, I'm a lot more relaxed nowadays than I was a few years ago when I try to predict where these things were going.
Yeah.
What I try to do is I try to develop a strong core position, and I try to buy particular companies or ETFs that I like when they get into an area that I feel represents very good value. And so right now I've got quite a bit of that. I've been making kind of steady purchases, and I know most people don't agree with what I think it should be doing right now, but that's fine, and I think that's the way you make significant money, is going against what most people feel. And right now, from the sentiment indicators that I've read, sentiment is as negative as it's been any time during this bull market, and people seem to be more depressed about things now than they were when silver in December was $26. It's over $30 now, and when gold was substantially lower. So it indicates to me, and with this tremendous gap between the gold price and the gold producer's price, I really think that people that are sensibly adding to their positions, doing their homework in here, and keeping some cash on hand for what Doug Casey calls stupid cheap prices, if we get those, I think that's the way to go. But I think trying to go to cash and trying to anticipate when this turn is going to happen, I think it's going to leave some people holding a lot of cash but no positions.
So what's the alternative?
Well, the alternative, it depends on your worldview. If you think this bull market is over, like a few of the pundits on the talk shows do, then I guess you go to cash and you buy Apple at $600 a share. But
Crazy.
If you feel that we have a long ways to go, which I do, and I'm willing to put up with the pain for the long-term gain, then you look for quality assets, and when they get into an area that you think is good, you buy some.
Okay, well, now what about folks looking at some of the ETFs or some of the specific stocks? We are looking at an area where they're really beaten down. How do you fight the general market psychology that these things are trash?
Well, it's a psychological factor, and you have to look inside yourself and say, what am I about, and what do I want to accomplish, and what level of risk am I willing to take, and am I willing to go against what an awful lot of people think is a certain way. And historically, the people that have made good money have been ones that went against, what everybody else was thinking. I was just reading a report that was released by a couple of UK economists just this month about John Maynard Keynes, and not many people know this, but he was a very good stock picker.
Okay.
Wow. After the big market crash in 1929, where his portfolio was pretty much wiped out, he realized he couldn't call tops, and he also couldn't make money by buying what everybody else thought was. So he started becoming a contrarian, and he went a bottom-up approach, and he learned about the companies and met with management when he could, and he bought stocks that were out of favor but that he felt strongly were good values, and he made very good money even in a deflationary environment. So my comment would be, go against the herd, do your homework, know yourself, and know what you're trying to accomplish, and go for it, because you just can't make it if you're trying to get the latest pick on the latest Mad Money news, because it just isn't going to work for you.
David Smith, our guest. He's a precious metals analyst and frequent contributor to the Morgan Report at silver-investor.com. David's at the World Resource Investment Conference in Vancouver, June 3rd and 4th. Details at cambridgehouse.com, and at Money Expo in Victoria, June 16th. You can find out more at moneyexpo.ca. Dave, thanks for talking to us.
You bet. Great talking to you, Phil.
Thanks to our guests, Marin Katusa, Gerald Celente, and David Smith. And thanks to you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.